Market forecasts. Status quo for now, but more defensive positioning warranted later. At the end of last year, we raised our fixed income allocations to neutral from underweight for the first time since the early days of the pandemic. As previously stated, we are looking to overweight rates at increased duration next quarter, or if the US 10-year yield rises to 4%, whichever comes first. On the equity side, we also remain neutral given heightened negative investor sentiment and bearish positioning. According to the most recent American Association of Individual Investors survey, bears surpassed bulls by 23 points. For perspective, the survey's 36-year historical average is for bulls to exceed bears by 6 points. And according to the latest March Bank of America's Global Fund Manager survey, portfolio managers are currently 2 standard deviations underweight equities. Not to mention that this is the most anticipated recession in U.S. history as determined by professional economic forecasters. Usually, our experience says that when there is this level of pessimism and consensus on an outcome, it never pans out as expected. In the extremes, taking the contrarian position is an attractive one. As was our stance last quarter, geographically, we still favor equities outside of the US over their American peers. This chart suggests that American stocks are still trading more than 1 standard deviation overvalued versus their median premium to ex-US stocks. US equities trade at 18 times multiple with forward earnings, while non-US stocks are trading at only 12.5 times. In other words, US stocks are still too costly. In sum, we retain our neutral positioning on both equities and rates for the second quarter of the year, but our subsequent move will likely be to downgrade equities and upgrade bonds in the second half of this year. The most prevalent sources of uncertainty are the timing of the onset of the US recession and geopolitical events around the world. We are attuned to heightened risks emanating from the Russia-Ukraine conflict, the US debt ceiling ex-date, and Iranian-Israeli escalation. On behalf of the Insignio Investment Committee and our entire portfolio management team, we want to thank you for your continued trust and support. We wish you a joyous and successful springtime. Insignio Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignio International Financial Services, LLC, headquartered in Puerto Rico, and through Insignio Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignio Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignio International Asesores de Inversión Uruguay, SA, Insignio Asesores de Inversión Latam, SRL, and Insignio Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignio Argentina, SAU, and in Chile through Insignio Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up Insignio Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignio.com/disclosures/ or via www.finra.org. To learn about Insignio Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.